What if I told you that every major financial crash doesn't destroy wealth, it transfers it? While millions panic, sell at the bottom, and watch their savings evaporate, a small group quietly gets richer, not because they're smarter, not because they work harder, but because they understand a hidden playbook most people never learn. Here's the mystery. If crashes are so bad for everyone, why do billionaires buy more assets during recessions? Why do the richest families barely flinch when markets collapse? And why does wealth inequality explode after every crisis? Today, I'm going to reveal how the rich protect their wealth during crashes using strategies that repeat across history, and how these systems are designed to reward preparation, not panic. But first, we need to go back in time, because this story didn't start in 2008. It didn't start with COVID, it started centuries ago, when money itself was redesigned. Most people believe crashes are accidents, unexpected disasters, black swan events, but history tells a different story. Every modern crash follows the same pattern. Easy money gives asset, bubble gives debt, explosion gives panic, gives wealth transfer, and this cycle isn't random. It's built into how financial systems work. Let's rewind to the early banking era, when private banks gained the power to lend more money than they physically held through fractional reserve banking. Something changed forever. Money stopped being limited by gold and started being limited by confidence. That meant booms could be artificially inflated, and when confidence broke, everything collapsed at once. Here's the key twist most people miss. The people closest to the money system, bankers, large investors, institutions, always see the cracks forming first. They don't wait for headlines, they reposition quietly. And when panic hits the public, they're already prepared. This is where the real story begins. Let's look at the Great Depression. In 1929, markets collapsed, banks failed, millions lost jobs, families sold assets for pennies just to survive. But while the public was selling, insiders were buying. Large investors with cash and access to credit purchased farmland, factories, and stocks at historic discounts. By the mid-1930s, many of America's most powerful fortunes were built directly from this crash. Same pattern, different decade. Fast forward to 2008, the housing bubble bursts, people lose homes, retirement accounts are wiped out, fear dominates every headline. But behind the scenes, something else happened. Hedge funds bought foreclosed homes in bulk. Private equity scooped up bankrupt companies. Banks received bailouts and cheap money from central banks. Within years, asset prices recovered, but ownership had shifted upward. This wasn't luck, it was preparation. Here's where most people get it wrong. They think the rich react during crashes. In reality, the rich prepare before them. Crashes don't come out of nowhere. They build slowly. Debt levels rise. Interest rates shift. Asset prices detach from reality. Central banks change policy. Wealthy investors track these signals obsessively. And when warning signs appear, they begin repositioning quietly. Let me show you how this works. 1. They move into defensive assets early, before panic hits headlines. Institutional money rotates out of speculative stocks into cash, bonds, commodities, and hard assets, into businesses that survive recessions. They don't chase hype, they preserve flexibility. 2. They reduce personal risk exposure. While average people stay fully invested because the market always goes up, the wealthy rebalance. They lower leverage, reduce bad debt, lock in profits, prepare liquidity. Liquidity is the weapon of crashes. Cash isn't trash during collapses, it's power. 3. They build relationships with capital providers. This is critical. During crashes, banks stop lending to average people. But large investors still get access to cheap money because they're considered safe borrowers. That means when prices fall, the rich can buy using borrowed money while others can't even qualify for loans. This creates an unfair advantage most people never see. And now we arrive at the breaking point. Every crash reaches a moment where fear peaks. News cycles scream economic collapse. Social media spreads panic. People rush to sell. This is where emotional decisions destroy wealth. Here's what happens. Retail investors sell at the bottom. Homeowners dump properties. Small businesses close permanently. But what's happening quietly at the same time? Institutions start buying because they understand something most people don't. Markets recover, assets rebound, governments intervene, money gets printed, and when recovery comes, whoever owns assets wins. This is the cruel paradox of crashes. The worst things feel emotionally. the better the long-term buying opportunity becomes. But there's more, because after the crash comes the fallout phase, and this is where wealth consolidation accelerates. After crashes, governments step in. They lower interest rates, they inject liquidity, they bail out systemically important institutions. Sounds helpful, right? But here's the hidden effect. Cheap money inflates asset prices again. Stocks, real estate, businesses. And who owns most assets? The wealthy. So, while wages stagnate and everyday people struggle to rebuild savings, asset owners recover faster and grow richer. This is why wealth inequality spikes after every major recession. It's not accidental, it's mathematical. The system rewards asset ownership, not labor. And this brings us to the part nobody talks about. Failed fixes. After every crash, politicians promise reform. They announce regulations. They blame greed. They hold hearings. But structural incentives stay the same. Banks remain too big to fail. Asset markets remain central to economic growth. Money creation continues. So the cycle repeats. Boom gives bust, gives bailout, gives bigger boom, and the rich. They simply adjust their strategy and wait for the next opportunity, which leads us directly into the modern era. Because today's environment looks dangerously familiar. Debt is higher than ever. Asset prices are inflated. Governments rely on money printing. Household savings are shrinking, and the next downturn, whenever it comes, will follow the same script. But here's the important question. If the wealthy use preparation, liquidity, asset control, and emotional discipline to protect themselves, most people think diversification means spreading money across a few stocks or bonds. The wealthy think differently. Step 1. Hard assets. Real estate, especially cash-flowing properties that don't depend on short-term market hype. Commodities, gold, silver, and agricultural products often rise when currencies and markets fall. Art, collectibles, and other alternative assets that retain value even in panic. Step 2. Global diversification. Owning assets in multiple countries shields against local recessions or currency collapses. Example, during the Eurozone debt crisis, investors who held foreign stocks, commodities, and currencies preserved their wealth better than those concentrated in European assets. Step 3. Private assets. Private equity, venture capital, and private debt are less volatile than public markets. Crashes often depress public valuations, allowing wealthy investors to buy private stakes at discounts before they go public. The lesson: wealth protection isn't about holding one safe asset. It's about creating a network of asset types that react differently during shocks. During a crash, everyone panics and sells what they need to survive. The rich, however, hold cash reserves and credit lines ready to act when opportunity strikes. Think of it this way. Average person sells stock at 30% loss because they need money. Wealthy person uses cash or borrowing to buy the same stock at a discount. Liquidity is power because it allows wealth to grow when prices are lowest. Historical example: 2008 housing crash. Retail investors panicked and sold homes. Hedge funds and wealthy buyers with liquidity scooped up entire neighborhoods at 30 to 50% discounts. 10 years later, those same properties had doubled or tripled in value. The message is simple. If you can maintain liquidity during a crisis, you can turn fear into opportunity. Leverage has a bad reputation, often deservedly. But the rich use it strategically. They borrow when asset prices are low, interest rates are favorable. They have a safety cushion in case the market falls further. The difference: timing and discipline. Most people over-leverage at market peaks, borrowing when prices are high and panic in. The wealthy leverage during troughs, buying assets cheaply and paying off loans as the economy recovers. Key principle: leverage amplifies gains if used with insight, and destroys wealth if used with fear. Wealth protection isn't just about numbers, it's about mindset. During crashes, fear drives the majority to sell at the worst possible time. Greed tempts some to chase risky assets after recovery begins. The rich train themselves to stay unemotional. They study market cycles, historical precedents, and economic indicators. They set rules for entry and exit points in advance. They avoid news-driven panic. Psychology is a tool. Emotional discipline allows them to buy when everyone else sells, the classic Warren Buffett approach. Be fearful when others are greedy, greedy when others are fearful. Another secret weapon of the wealthy is legal structuring. Trusts, holding companies, and offshore entities protect assets during market downturns. Tax loss harvesting, selling some investments at a loss to offset gains elsewhere. Estate planning ensures wealth doesn't erode across generations during recessions. These are anti-shady tactics. They're anti-shady tactics. They're smart planning that reduces financial drag when markets are volatile. Now, let's connect history to today. Global debt is at record highs. Inflationary pressures persist worldwide. Central banks continue to print money and artificially suppress interest rates. Sound familiar? Every major crash in history shares this combination. Excessive debt, asset bubbles, and loose money. Modern data shows. The S&P 500 has recovered from crashes faster than wages or household savings. Billionaires' wealth often grows during crises. During the COVID market crash, the top 1% gained billions while millions lost jobs. Real estate, gold, and cryptocurrencies have all acted as protective assets during volatility. These repeating patterns confirm the rich protect themselves using historical strategies that anyone can study and emulate. 1. Focus on assets, not income alone. Don't rely solely on your paycheck. Build assets that grow independently of your job. 2. Prepare liquidity before crises hit. Cash or access to borrowing is more valuable than any hot investment during a downturn. 3. Control your psychology and plan ahead. Crashes are predictable cycles. Emotional discipline and a clear plan turn panic into opportunity. Bonus tip. Don't just copy the rich. Blindly understand why they act a certain way and adapt to your situation. Here's the uncomfortable truth. The next major crash is inevitable. Debt levels, speculation, and economic imbalances guarantee it. Governments may delay it, but they can't prevent it indefinitely. If you wait until the panic is on the front page, it will be too late. The question isn't if a crash will happen, it's will you be ready when it does? History has already answered that question for those who pay attention. Now that you understand how the rich protect their wealth during crashes, review your own assets, increase your liquidity, study cycles and indicators. Consider diversification beyond traditional investments. And if you found this insight valuable, subscribe and turn on notifications for part 3 of our series. How ordinary people can apply the rich's crash-proof strategies today. Because the wealth playbook is no longer a secret, it's a matter of timing, preparation, and discipline. Remember, crashes aren't disasters, they're opportunities. An opportunity favors the prepared,